welcome to Halftime Report. I'm Sonia Shenoy. With me is Ekta Batra and Mangalam Malu. We're getting into festive season and you have Dhanteras, then you have Diwali, of course, so lots of action. For the market, it's cut its losses from early morning, and now the only problem pocket really is the mid-cap index. The Nifty is not doing much, just sort of buying time around the 17,500 level. But the mid-cap index is under pressure now, down about 230 odd points. I think the bulls still have a grip, although the grip must have loosened a little bit. The FI selling has reduced quite a bit, and despite all the challenges that we're seeing in the global market, it's not a bad outcome.
Hi Mangalam, hi Sonia. Yes, absolutely. And I think one thing that stands out is, for example, IndusInd Bank, which is down around 4% and a similar case in point would be something like a Syngene, which has not reacted too much despite the fact that the company is quite bullish on its guidance, though it did see a run up yesterday. And the two commonalities between the two is valuation. So maybe specific stocks valuations are probably going to come into light, and something that the street will probably notice going forward as well, that yes, you report good numbers, but are the valuations too hefty at this point in time? But nonetheless, for the Bank Nifty, currently down around 1%. So let's see whether there's any kind of reprieve in the second half. Hi Mangalam, lot of numbers today.
A lot of numbers to reckon with. And for me, FMCG, you have Colgate today, you have ITC today, you have Tata Consumer today, you have Asian Paints today, and tomorrow you have HUL as well. But I'm just watching out for Canara Bank, because there was a flash at the bottom of the screen which said that a large part of their profits actually came in primarily because the company shifted its tax regime, and as a result of which their profits benefited by about 2,450 odd crores. So maybe there was a smidge of a correction from the highs on the stock. When the numbers came out, the stock was up around 2.5%, sitting with a gain of about 1.5%. These were good numbers, but just an additional kicker coming in on the bottom line on account of them shifting their tax regime. But just keeping an eye out on a bunch of other stocks as well. Delhivery, for instance, is one of them, which is lower in how in today's trading session. Everyone was hoping that, the company would do well in the third quarter. That's still to be seen. The question is that, will they do well at the cost of profitability or not? Because in the second quarter, the sentiment continued to remain weak and broadly unchanged from the first quarter. They said spending remained muted due to the continuing high levels of inflation, and express parcel volumes, they remained stable in the second quarter as compared to the first quarter, picked up towards the second half of the second quarter, which was ahead of the festive season. So now the street will be looking at what the company does in the second half of this year, primarily because we'll have the festive season and a lot of these e-commerce sales coming by. The question is, will that come at the cost of margins or not? Because service line volumes for the business, while it grew in high teens in the second quarter, supply chain and full truckload volumes declined quarter on quarter, and they anticipate moderate growth in shipment volumes through the rest of FY23. Not good update coming in from the second quarter, and the street does not like it one bit. The stock is down almost 13%.
So it didn't deliver.
It didn't deliver, at least on the financial parameter. Well,
okay, but as you were telling us, by the way, those are some net interest margins coming in for Canara Bank. It's been a good one this time around for Canara Bank. For the banks in general, right? They've done really well, and the net interest margins for Canara Bank have picked up. On a quarter-on-quarter basis, there's a good amount of an up move. But you were telling us about all the earnings that you're going to get hit with today. Asian Paints is due to report its second quarter numbers as well. What's the expectation?
Trust me, all the earnings that I get hit with, I will hit it right back at the viewers and give them every number that we have to track. So as far as Asian Paints is concerned, numbers expected in the next couple of hours or so. It's a good quarter that the street is working with this time around. 25.5% growth on the top line. You're looking at around 8,900 crores. The EBITDA actually grows 75%. At around just shy of that 1,600 crore mark. That obviously is on account of multiple things. One, the company's taken a lot of price hikes, so they could benefit from that. In the same time, last quarter, margins were at 12.7%, which was a record low for the company as far as margins are concerned. So on that low base, the margins are likely to look strong around that 17.8% mark. And the net profit likely to grow by 80%. You're looking at a number upwards of 1,000 crores, 1,075 crores to be precise. What leads this 25% revenue growth for the company? Domestic volume growth seen between 14 to 15 odd percent. The company has in the past said that they are comfortable with margins around that 18 to 21% mark. So we'll watch out for, you know, what they do out there. And they expect the second quarter inflation to be 1.5% over the first quarter. So is that, you know, reflecting in the kind of price hikes that the company has taken already? Because in this year itself, from November 21, they increased prices at around 8 to 9%. December, we had 4 to 6% hikes out there, 15%, and about 17.5% over the last year. My sense is that realizations would be higher by about 12 to 13 odd %, and the rest of the revenues would come in from volume growth.
Okay, so that's on Asian Paints. Let's see what they eventually deliver. But the one stock that we did mention right at the start of the show was IndusInd Bank, which is the top loser, the Nifty. This is despite reporting what were good statistics in Q2. Abhishek is here to tell us what the street probably didn't like, and maybe it's the valuations which are now weighing down.
Well, to begin with, you know, it was a strong quarter for IndusInd Bank, given the fact that there were many records that were made in this quarter. So in terms of operating profit growth, both YOY and quarter-on-quarter, they have been consistently giving it for 8 quarters in a row. So net interest margin is at 9-quarter high of about 4.24%. The return ratios, both the ROA and ROE, are perhaps the best in last 11 quarters, with ROA at 1.8% and ROE of 14.5%. YOY, the loan growth is one of the best in last 11 quarters, and sequentially as well, the loan growth is pretty strong over there. NII growth is also robust on a YOY basis, perhaps at a 9 to 10 quarter high. Slippage ratio is one of the lowest that you are seeing in last 8 quarters, coming in at just 2.42%, and gross NPA ratio is at 14-quarter low, coming in at 2.11% when compared to 2.35% in the previous quarter. Both the NII and PAT are a beat on our poll. Perhaps, you know, one worry that I have been getting from analyst feedback is that the management, you know, commentary or the management succession with respect to Sumit Katpadia, you know, going ahead, as the board has already put it on record with RBI with respect to 3-year extension. Let's see how that progresses. We'll be seeing closely.
All right, we take that point, Abhishek. We'll, you know, also, before we let you pour on more details for Canara Bank, wanted your thoughts on AU Small Finance, among the top F&O losers in today's trading session, and this despite good numbers.
You know, con call over there, they have guided for a lower loan growth is what the analysts are giving a feedback. The loan growth guidance is now down to about 26 to 27% versus the 38-39% that they have recorded in this quarter. So the slowdown in loan growth might be a key reason for one of the worries that investors are having with respect to AU Small Finance Bank. Not taking away from the fact that the results are super strong, given the fact that net interest margin has expanded by 30 basis points quarter-on-quarter, which is helped by the fact that yields have expanded by 40 basis points, and the CASA ratio, or the low-cost deposit ratio, that has jumped up by 346 basis points quarter-on-quarter. AUM growth remains strong at 38% YOY and about 4.6% sequentially. The slippages have remained stable at 262 crores with an annualized slippage ratio of a little more than 2%. So gross NPA has improved 1.9% versus 1.96% in the previous quarter, and the restructured book has declined massively to about 1.7% when compared to 2.1% in the previous quarter. Both in terms of NII and PAT, it's a beat on our poll. Back to you.
Okay, thanks a lot for that, Abhishek. Well, that's on the banking space. But let's slip into a short break. When we come back, the big talking point has been the rupee. Once again, a fresh record low against the dollar.
Welcome back. Well, it's weak for the equities and it is weak for the rupee as well, which is now depreciated over 10% in 2022. Lata is here to tell us more. The rupee did hit a record low in yesterday's trading session in the second half and today as well. Lata, over to you.
Yes, following a rather precipitous fall on Wednesday by about 65 pies, the rupee is even weaker in morning trades. 83.20 or even 22.23 was a low that the currency touched. But for what it is worth, this is a global trend. US yields have surged so much. I mean, it's red hot inflation readings, UK, Canada, New Zealand. So US yields have surged, and as a result, you're seeing a dollar strengthening versus almost every currency. If you looked at some Asian currencies, I mean, yen is approaching 150. Yuan is at the lowest it has been since, I think, 2007 or 8. The Taiwanese dollar, the Indonesian rupiah, all of them are at multi-year lows. And therefore, we shouldn't be surprised by the consistent pressure on the rupee. What we are picking from the market here is that oil companies are up and about buying. Basically, all importers. Once that 82 was given up and 82.50 was given up, more and more importers panic and come in to buy dollars. On Wednesday, we heard of a foreign bank which had a lot of buy orders for a client. Now, these things are also not one-day affairs. They could stretch out. The foreign bank could be buying over several days. So we are going to see continuous pressure. The Reserve Bank, I guess, will not stand in the way when it's a tidal wave of selling across many countries, or they know that a very big client is pulling out money. They wouldn't want to make it cheaper for a person. Again, the market perception of the Reserve Bank also is undergoing a slight change. When you had, dollars for 9 months, 10 months of imports, the market doesn't try the central bank too much. As the central bank reserves come down to 8 months, there is a poker game between market people and the Reserve Bank. The market guessing that the Reserve Bank may not want to defend too much and expend reserves and may allow a bit of depreciation. So at the moment, the pressure clearly is on the currency, and there are people speaking about 84 sometime in 22 or in 23. Let me add a word about yields as well. We have seen a rise in yields, and that shouldn't be surprising. The US yields have gone up very smartly in the last 24 hours. 10-year at 4.15, the 2-year at 4.57. So, there is a concomitant rise in India. The crude prices are slightly higher, and there is an auction later today. That's another reason why people will want to sell and make space for the new bond.
Okay, thanks a lot, Lata, for that. That's an update on the rupee, the bond deals and the surge that we've seen over there. But let's get back to equities now. Rallis and DCM Shriram on our radar. Sonal is here, focusing on both those stocks. Sonal, over to you.
Thanks a lot for that. Well, for Rallis, it was a strong set. After quarters of underperformance, the company has been able to report decent growth, revenue growth of 31%, EBITDA growth of 34%, and this time around there has been a margin expansion for the company despite the raw material challenges that we've been talking about. So margins expanded 30 basis points to come in at 12.4%, leading to a strong profit growth of 26% in the quarter gone by, on the back of which the stock is doing well today. DCM Shriram, on the other hand, reported weak set. Revenues were up 28%, which was driven by the chemicals business. However, EBITDA was down 3%, leading to a margin contraction of 400 basis points, and profits were down 19% as well on a YY basis. What was it driven by? It was driven by their vinyl business, where they reported a loss this time around of 10 crores versus a profit last year of 156 crore rupees. Even the business even their sugar business did not do so well. Reported a loss of 15 crores versus an EBIT of 33 crores. They said it was a one-time impact of 15 crore losses that this particular business took as well. Company spoke to us in the morning. They said that vinyl business is significantly impacted due to global factors. There is lesser capacity utilization as well. However, going forward, margins for FY23 should be between 14 to 15%, which is higher than the 11% that they did right now. So positive management commentary. The stock has recovered.
Welcome back. The Nifty has picked up some pace from the lows. Currently, in fact, it's hovering around just under that 17,500 mark, and that is something we'll be monitoring, because this comes despite the weakness that we're seeing on the Nifty Bank. The reason why the Nifty is doing well is because Reliance is outperforming, and at the same time we have Bharti Airtel, which has moved to the high point of trade as well. 17,500. That is an important mark to watch out for, primarily because it's also the weekly options expiry today. Where are the active put writers? Well, 17,400, extremely active. That put should come up for you. Crore shares written in open interest for a premium of almost 10 odd rupees, and then the bulls are getting aggressive on the 17,400 put as well, which also is seeing a fair amount of writing. What does that mean? Bulls expect support anywhere between 17,385 to 17,400. Today's low on the Nifty, 17,421, is extremely crucial to watch out for. On the way up, active call writers are at 17,500 and 17,600. So bears expect some sort of resistance between 17,500 to 17,550. And the reason for that is because the 50-day moving average is where the Nifty is at right now, 17,496. And yesterday's high, from where we saw that dramatic fall of 100 points from the top of 17,607, is something that we'll be watching out for. What do straddle writers, or the ones who write both calls and puts on options expiry day, gun for? The 17,500 mark, which is the fulcrum, has a combined premium of 70 rupees. So that means they're looking for a range between 17,430 to 17,570 on the Nifty.
Okay, all right. Well, let's toss that question to Jay Thakkar of Marwadi Shares and Finances, who joins in on the show. Jay, good afternoon and happy Diwali to you and your team in advance. This has been a tricky one, right? Between last summer to now, the Nifty is down about 5%. So it's not been a great year, but then it's not bad compared to the global setup. What is the strategy for a slightly more medium term? And what are the stocks that you're looking at today?
Hi, very good afternoon to you, and thanks and wish you and the entire team of CNBC-TV18 and all the viewers of CNBC-TV18 a very happy and a prosperous Diwali and a new year in advance.
Thank you.
And as far as the index view is concerned, I would say that on the upside, I mean, we had a target of 17,500, 600, which I had shared on your channel as well a couple of days back, and that has got achieved. And I believe that going forward too, I mean, 17,500, 600 range is going to be, quite decisive. I mean, that's where we are also seeing, as Mangalam rightly pointed out, the good amount of, option writing that has happened at 17,500 and 600 strikes. And if Nifty manages to surpass these levels and sustain above these levels, then I feel that next target on the upside would be 18,000, 18,100 on the Nifty above these levels. And on the downside, I believe that the kind of writing which we have seen happening today on the expiry day, as well as for the next weekly expiry, which is going to be the monthly expiry as well. I mean, 17,200 to 400 range is going to be quite an important support range for the Nifty. And as far as the Bank Nifty is concerned, I believe that 39,000 is likely to hold for a while. And I believe that once it manages to surpass the levels of 40,500, we are going to see further momentum building up out there as well. So overall outlook, at least for the short term, is positive. On the medium term, I believe that once Nifty manages to take off 17,600, then yes, it's heading towards 18,000, 18,100 levels. There is where we can have further review for the long term as well. Now, as far as the stock strategies are concerned, I believe that there are a few of the insurance-based stocks which have beaten down quite a lot and are showing positive divergence, among which one is ICICI Pro, on which I have a buy recommendation. It's trading at around the levels of 514. One can buy this as the risk reward is quite in favor of the bulls, at least for the short term. One can buy for a target of 535 to 550. And on the downside, one can place a stop loss at 502. The second buy recommendation of mine is on Eicher Motors. I believe that among the auto pack, TVS has done quite good, and two-wheeler pack have been doing absolutely, and it's been outperforming the four-wheeler as well. So Eicher Motors at around the levels of 3,600, one can buy this. One can target 3,750 to 3,900, and on the downside, one can place a stop loss at 3,500.
Okay, we're going to leave it on that note. Thanks very much for joining in and giving us those calls, Jay. Well, for steel strips, it's a bit of a subdued performance. The net profit is down around 13%, so 55 odd crores is what it's coming at. Revenue up around 13%, so maybe margins are pressured this time round. Need to take a short break, but here's some great news for investors. You can now track the US markets in real time on Money Control. Just log on to the Money Control website or the app and stay informed about all the matters in the global markets. Welcome back. Well, we've been discussing how it has been weak for the equities as well as for the currency market. So just a quick comparison in terms of how the rupee has done as compared to its Asian peers on a year-to-date basis. So while the rupee has depreciated close to around 11% on a year-to-date basis, which is basically in 2022, the South Korean won has depreciated over 16%, the Philippine peso over 13%, the Thai baht over 12%, the ringgit, the Malaysian ringgit over close to around 12%, and the Chinese currency is also depreciated around 12%. So in comparison, if you look at the rupee, yes, it is depreciating, but as of now, the depreciation seems to be less as compared to our Asian peers. But the pace of depreciation matters considering the rapid depreciation we've just seen in the past 2 days. So whether or not the rupee catches up is something that the street will watch quite closely. So that's on the rupee, obviously impacting the sentiment in the equity market.
Wow, that's quite a bit, over 10% depreciation before you know it, right? The rupee's at 83, all right. But let's move on. Steel Strips reported its Q2 earnings just a while back. Now, the top line growth was not bad. It's a 13% growth, but it's the operational numbers that have been weak. The margins have contracted quite a bit. They've fallen to 10.8%. Remember, last quarter as well, the margins fell to 10.8 versus 14.4%. So there's clearly raw material pressure that we're facing here for Steel Strips. Dheeraj Garg, the MD of Steel Strip Wheels, joins us now to talk about that. Dheeraj, good afternoon and thanks for joining in. First on the margins, now that raw material prices have cooled off, when do you start to see the benefits of that? And when do you think you can get back to those 14-15% margins you used to enjoy last year?
Let me clarify one thing upfront. The margins per wheel on an absolute basis are almost the same as they were last year. So we made the same amount of money per wheel. But since the raw material prices went up, so you see a decline in the percentage of the EBITDA percentage because of the increase in sales price. So going forward, yes, raw material prices are coming down quite well. And so again, this number of 10.5% will go up to 12.5% as the raw material prices come down. So this is a typical cycle, but we have not lost money on a per wheel absolute basis.
Tell us, what is the number, margins per wheel? What is it right now that you're enjoying? And what is the average that you're expecting for the full year?
So we are about at 255 rupees.
Okay.
And we expect this margin to go up to 270 rupees in the next 6 months.
All right, we take that point. Just wanted to understand on your top line as well. The first half of this year, you've done around 2,100 odd crores. That's absolutely in the middle of what you had guided for the entire year, 4,200 odd crores in terms of the domestic business. And can you tell us how exports have performed as well? Because there too, you had said that, you would do about 650 crores this year.
So let me sort of give you a macro picture of the entire breakup. Our aluminum business has grown about 111%. Our CV business has grown 100%. Our tractor business has grown 30%. Our pass car business, steel business has grown 40%. What has not grown, in fact, has degrown is the export business. Export business is down about 70%. And to answer your question, for the whole year, earlier we had projected or guided about 650 crores, but we are looking at about 450 crores. We have to be a little bit more circumspect considering the global sentiment, that's available right now to us.
Sure. Sir, did you mention exports are down 70%, 70?
Correct. Yeah, YOY for the first 6 months.
Okay. Are there any aberrations in the export business this quarter? On a steady state, do you expect this kind of a decline to continue?
No, as I said, we will make up for this, lack of exports in the first half. In the second half, and we are hopeful to clock about 500 crores, 450 to 500 crores versus 850 crores last year. So the decline would be not 70%, would be a lesser amount.
Okay.
Okay. You supply to a lot of segments, right? Trucks, passenger cars, 2- and 3-wheelers, tractors. In that entire gamut, 2-wheelers are still struggling a bit, not just in the export market, especially markets like Africa, but even back home in the domestic market, recovery has not been great. What is your contribution, or what's the contribution to your revenues, and how do you expect it to shape up?
In fact, the two-wheeler business has grown over last year. I don't know the exact number, but in terms of the top line growth or the EBITDA accretion, it's a very small number. So really, it's not a big game changer for us, the scooter business. But the other business we all need to focus is on the CV business, the aluminum wheel business, and the regular pass car 4-wheeler business in steel.
So,
and tractor business.
As far as the alloy wheel business is concerned, I remember you had guided for another 45 to 50% sort of growth in your overall, alloy wheel portfolio. Can you tell us where does it stand right now as an overall percentage of your mix, and what rate is it likely to grow at?
So I just mentioned that we grew 111% in the aluminum alloy wheel business, and we are hoping to even do better in that. Of course, the rate of growth may not be as much, but the sequential growth would be about 10% from where we are right now.
That's exactly why I asked you. 111% is what you've grown at, and you guided for 45 to 50%. So there is a case for upping that guidance as well, right?
Yeah. Yes. So I wouldn't know the exact number, but we are looking at a top line growth of about 1,200 crores in the aluminum space.
Okay.
Versus I don't know how much it was last time.
I just wanted to revert back to the export business because of the kind of decline that you've seen and you are anticipating going forward. How much of your exposure is to Europe, and what are the trends that you're seeing there in terms of demand? And if you had to break up what your export demand is looking like geography-wise, which one would you probably be confident on? So how is Europe looking, and which are the markets that you're probably confident on in terms of growth?
So our major export market is the US market, and there we see a lot of decline in sales, especially because of high inventories and decline in raw material prices. So a lot of people are sort of circumspect about buying more material. But now going forward in the next 6 months, we see some traction coming back. And we hope, as I was saying, that we will do better than the first half of this year in exports. And so majority is North America, but Europe is also declining, but not at the same pace as North America is declining.
Okay. In the passenger vehicle space back home, you are supplying to a lot of the fast-selling new products, whether it's the Tata Nexon, the Tata Harrier, and you already supply to names like Kia, etc. Any more, clients, have you added them to your order book, and any kind of visibility that you have over the next 1 year?
Yeah, so it's a great question. Our order book, as we speak right now, is good till 2026, based on current capacities. And we are adding more capacities, and our 1 million plant will be commissioned by March of 2023. So that should give us a big leap going forward in terms of increasing our market share. Today, we are #1 in the country in terms of market share of aluminum wheels. And going forward with this addition of 1 million wheels, we will be targeting the export market from where we have a great traction right now. And our target is to build up to 10 million wheels in 3 years' time from now. So we are pretty much on track, and we're very, very positive on the aluminum wheel business.
But 3 months ago, Right. 3 months ago, you had spoken about a possible joint venture in the motors business. Can you tell us if there is an update on that?
Correct. So we are working on two things. We are working on a controller product, and we're working on the motor product. And both these negotiations are going on as we speak right now, and we are perhaps going to be announcing something very shortly. It has dragged on more than we anticipated, but it surely is happening, and this will be a big game changer again for us by foraying into the EV space.
Okay. All right. So we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Steel Strips. The stock is down around 2%, but they are quite bullish on their margin per wheel rising going forward to around 270 rupees in the next 6 months. Currently stands at around 255 rupees. In terms of exports, they're probably seeing a bigger decline in the North American markets as compared to Europe. Take a short break. We'll get you more on the markets once we're back. Stay tuned.
Welcome back to Halftime Report on CNBC-TV18. Well, in our special segment Value Add, Ekta is focusing on Syngene, the stock that's surging in trade right now. Ekta, over to you.
Well, yes, Syngene yesterday came out with its numbers during market hours. The stock closed higher in yesterday's trading session. It was up around 6% And there is a conference call which is taking place as we speak for Syngene. So let's see what the takeaways would be. But a couple of key important points stood out. The revenue growth this quarter was strong. It was at around 26%. 9% of that 26% was aided by a rupee depreciation. Double-digit growth is what they have said was what took place in the underlying business ex of COVID-19. Now, guidance was maintained. Remember that they guided post Q1 for high teen top-line growth for FY23, EBITDA margins of around 30-odd%, and they expect single-digit profit growth, which is likely to be impacted by financial expenses, tax rate, other income. Now, in terms of demand, they said that there is solid organic growth in the discovery services segment. They are seeing pent-up demand taking place. They're seeing healthy demand from smaller clients, and they're seeing a structural shift take place in the past 3 to 4 years. Now, the big deal is Librela, which is basically a drug used on animals to treat osteoarthritis. It's by the animal health company Zoetis. The company is going to start commercial manufacturing in Q4 of FY23. It's a 10-year contract that Syngene has won for it. The US FDA approval is awaited while they've received European approval, so that's an important factor. And the Zoetis deal contribution is only expected to begin next year. But nonetheless, this is something that the street is quite bullish on. And that's reflective in terms of the valuations. FY23, 49 times based on an EPS estimate of around 11 to 12 odd rupees, and 40 times FY24 if you're working with an EPS estimate of around 14 to 15 odd rupees. We did speak to the management earlier in the day, so let's listen into what they had to say.
So the qualification steps are really getting ready for that manufacturing, having all your plant qualified, getting the regulators both from the European Union and also from the US to come in. That should be happening in the second half of this year. The timeline is difficult to predict. It's as long as it takes the regulators to conclude their inspections and give us the feedback report. If you assume that those are successful, then we're into manufacturing as soon as the fourth quarter of this financial year, and that really then starts to ship and become a revenue driver from the very beginning of the next financial year. Most of our industry, just about everything we price is in US dollars. So if you've seen the US dollar strengthen, that flow back into repatriating it into the rupees is a structural benefit for us. At the 26% growth in the second quarter, you could knock off 9% of that for currency impact. But that still leaves you with pretty healthy underlying growth on a constant currency basis.
All right, so that was our value plus on Syngene. From one special offering, let's move on to the other special offering that we have for you here on Halftime Report, Insight Edge, where we get you, an edge over the insight that the management provided in the conversation that they had with CNBC-TV18. And Havells spoke to us before the conference call as well. Vahista joins in with what she made of both the conference call and the management communication that happened on the channel today.
Well, thanks for that, Mangalam. Actually, Havells India has had a very weak quarter this time, and the miss has been on the margins. The estimates were at 10.9%, which is anyways lower than the 13.8% which was clocked in the same quarter of last year. But the actual margins have come in even lower at 7.8%. The company says that the margins were impacted owing to the full absorption of high-cost inventory, which is against the falling raw material prices. But the silver lining is that margins are expected to witness an uptick Q3 and Q4 of this current ongoing financial year. Also, the company has mentioned that the consumer demand is sluggish at present. The electrical consumer durables revenues were impacted due to short-term destocking in fans, which was led by the changes in the energy efficiency norms, but they expect margins to normalize in Q3. Lloyd's contribution has also turned negative, with EBIT margins dropping to negative 20%. Now, in terms of the con calls, the management acknowledges that there is a high competitive intensity and was unsuccessful in being able to pass on the full raw material price rise to the consumers. But the price hikes will take place in Q4 of the ongoing financial year, and they are confident that these price hikes will be absorbed. So expect normalized margins in Q4. Also, the company will continue high investments on building brands, and hence more advertising spends could be expected, which includes for the Lloyd's brand. The inventory buildup is also strong for the festive season, even though the consumer demand is sluggish at present. The market share in cables and wires business is at approximately 15%, while in ACs is at 12 to 13%. In the first half of the ongoing financial year, the company has spent approximately 150 crores of capex and plans 700 crores total for FY23. Even with a high cash balance currently, the company is not looking at any mergers and acquisitions opportunities, at least in the near future. And the focus is on increasing their rural penetration, which at present is at approximately 5%. This is by introducing more products.
Okay, all right, Vahishta, thanks very much for that. So that's on Havells. Before we listen to the management of Havells, those are the Eris Life numbers. It's a sharp fall that we've seen in margins. Remember, a lot of the companies did benefit same time last year because of COVID, but nonetheless, even ex of that, margins have come in at around 33% as compared to 38%. But revenue growth has been strong. That's because there has been an overall recovery in the markets after COVID when it comes to drugs in the domestic market. For example, people are buying drugs more for cold, coughs and viral infections, and that's aiding companies such as Eris Life Sciences, which gets almost 100% of its sales from India itself. Let's in fact now get back to Havells and listen in to the management.
Welcome to Halftime Report, and joining us on the show now is Mr. Atul Chaturvedi. He's Executive Chairman at Sri Renuka Sugars. Mr. Chaturvedi, hi, thank you so much for joining us. And festivities is all we're talking about right now. And within that, sugar clearly is the king of it all when it comes to commodities. What is the kind of demand that we're looking at for this quarter? And is it cyclical, would you say, that as do all other commodities see a pickup in demand, does sugar look at that too?
First and foremost, let me wish you and your viewers a very happy Diwali in advance.
Thank you. To you too.
Coming to your question, we see a lot of traction as far as demand for sugar is concerned, and our take is that this Diwali will be very, very sweet for the Indian consumers. In fact, earlier we used to pencil anything between 26.5 to 27 million tons of consumption on an annualized basis, but this time around we are penciling in about 27.5 million tons. So there's a definite pickup in demand as far as sugar is concerned.
And is this an all-time high number, 27.5, or has India done that before?
No, I would say this is an all-time high. And the other thing with sugar is that sugar, by and large, from the Indian perspective is inflation proof. All the commodities went through the roof, but sugar price, as far as India is concerned, remained where they were about a year back. So there's been practically no influence of inflation as far as sugar is concerned.
But the cost of production clearly would have gone up. So how do you look at the cost of production vis-a-vis the selling price of sugar right now?
So earlier, the trouble with the sugar sector was that they were saddled with sugar stocks for the full year. They would crush for about 4 or 5 months and then carry the stocks. But no longer now, with the diversion, big time diversion to ethanol. So the stock levels as far as factories are concerned has come off quite a bit. So it's a much more manageable stock level, which means that the interest has also come off a bit. So I think the big game changer as far as the sugar sector in our country is concerned is the ethanol play. And I would go to the extent of saying that sugar is no longer a sugar sector, it's energy sector.
All right, we get that. Yes, and the reports do suggest that 12% blending is what the industry is looking at in the season here. But the other big question that the sugar as an industry is looking out for is the export numbers. I mean, that notification just doesn't come. While, of course, we've been talking about it for some time. And what we also hear is that as has been the demand, it may not come via an OGL. And the first tranche perhaps could be 5 to 6 million tons. What are you hearing, and is it coming before Diwali?
No, what we are hearing is exactly what you are also hearing. But as an industry, we thought OGL would be a much better option for the simple reason that there's no reason for the government or the policymakers to actually be worried on sugar front. If you look at our numbers, Indian sucrose production this year is likely to be close to about 41 million tons. And even if you divert 27.5 million tons towards domestic consumption, you are still saddled with a lot of sugar. So assuming 4.5 million ton goes for ethanol, which again is a big question mark, because if they do not jack up the ethanol prices, the diversion to ethanol may not be all that great. It might stick around at the last year's level.
And when are those prices expected? When is ethanol pricing coming in?
So that is $1 million question. In fact, we were anticipating and we were expecting it to come off now, because now the next demand will start coming in from 1st of November. So they will necessarily have to increase the price, and they will have to reasonably compensate the industry because the FRP has actually gone up. So the our take is that this incentive, they will definitely come up with a new price, and that should come in shortly, maybe along with the export quota announcement for sugar. Possibly. Yeah.
Okay.
That's
All right, Manisha. Thanks very much for taking us through that conversation, and Mr. Chaturvedi as well. We need to wrap up on the show, but before we do that, that's Granules numbers. And I just want to pull out the margin picture for Granules, because remember, that was one of the key concerns for the company, because margins had fallen all the way to around 17% a couple of quarters ago. It had come in at around 17% same time last year, which was in Q2 of FY22, and now has recovered to a good level of around 21%. In fact, on a sequential basis, it's managed to maintain margins, so that should be taken positively by the street. Good EBITDA growth of around 61% and revenue growth of around 29% as well for Granules. Need to wrap up on the show. It's a wrap from Mangalam, Sonia, myself, and the entire team. Thanks for watching. Business Lunch up next.